Hello, everyone, and welcome to today's live stream. I'm Ed. I'm joined by Joe for today's session. We are going to be running through a few key trends that we've seen in GB as well as Iberia and Germany. And there's a couple of themes that run through this session. So we have a few themes around the growth of solar and the growth of wind in the space. We then go into some of the cannibalization. So this kind of concept that when a lot of generation happens at the same time, what does that do for power prices and what does that do for returns? That is very much a conversation around timing. We then go into a conversation where we're looking at the growth of those renewables and where they are located. So we've that is more focused on space. So we're covering time and space. And then we're going to go into a few bits where we're essentially wrapping up some of the things that have been delivered by Modo over the last quarter, as well as some things to look out for as kind of key risks we've highlighted, given some of the regulatory changes that have happened in the space recently. So without any further ado, I'm going to pass over to Joe, who's going to talk us through cannibalization and BESS.
Great. Thanks, Ed. So kicking off with solar cannibalization across Europe and what is becoming a familiar picture, really, I think, across Europe on spring days. And that is, of course, negative pricing across much of Western and Northern Europe. Here we're looking at a specific instance on the 27th of April at 11 a.m. But we can see many such instances of this across spring, really, in Europe. And this is really a product of solar generation really starts to pick up in spring. So we have longer days coming through, whilst air conditioning demand lags behind, temperatures are slightly lower. So we get increased supply and lower demand, driving a lot of negative prices. We can see here Germany is a kind of key culprit for these negative prices. So prices are at this time at minus £109 per megawatt hour. And in Germany, we have, around 100 gigawatts of solar meeting, say, 80 gigawatts of demand. And these negative prices are kind of really structurally baked into that market, really. So if we take another view of this data, looking here at the frequency of negative prices kind of in sum since 2020, we can see Germany is a kind of key leader here. We've had, around 1,500 hours of negative prices over these past 4.5 years, and kind of putting it in pole position above France, Spain, GB, and Italy on this chart. And I think what's interesting here is not just the kind of frequency of negative prices, maybe, but the value of those prices. So how negative do prices go, as well as how often they occur. And we can see that Germany is leading here as well. And I think if we compare this to Spain as a counterpoint, we can see that Spain has quite a high frequency of negative prices, so higher than in GB, but not a very high value from those negative prices. And those prices typically find a floor at or just below zero. A lot of the solar that's installed in Spain is utility scale and can be turned off. Whereas in Germany, I think much more domestic, kind of IKEA solar fence panels, things like that, that continue to kind of dump into oversupplied markets and drive those deep prices.
And just one item from me, just on housekeeping, which I didn't go through right at the start, is if you do have any questions as we're going, please do ask them. Put them into the Q&A function. We have a team that are backstage that can pick those up and can answer them as we go through. And also, we'll take some questions at the end. We'll have 15 minutes for questions at the end. So if you do have questions, please feel free to use the Q&A function. And Joe, back to you.
Great. Thanks, Ed. Yeah, people keen to ask questions, which is good to see. Um, yeah, and then I guess kind of moving on, expanding across Europe. Even here in Britain, we're not immune to these solar dynamics either. So we've had record solar generation in GB so far this year. So we're trending up here at around 12 terawatt hours of cumulative generation so far in 2025, putting us well above this time last year and the year before. Part of this is explained by an increase in installed solar capacity, so about 15% more solar plant installed than this time last year. That doesn't explain all of this, however. I'm sure, kind of as we've all felt anecdotally, we've had a lot of sunshine hours so far this year and kind of a relatively high solar intensity as well, which has driven this kind of solar generation up. We're still seeing that capture rates for solar are holding steady. So the capture rate is kind of the prices achieved by solar relative to the average wholesale price. On an annual basis, these are still hovering at around 100%. So solar performing as well as any other generator might be expected to perform in the market. But we're starting really to kind of see signs of this cannibalization come through in things like the monthly capture rate. So we can see in certain months, these capture rates drop down quite a lot. And then if we layer on the daily capture rates, we can see, we're already well past kind of having days of zero capture price. So solar kind of discharging into zero or even negative prices for the full day, not earning any revenues.
And I think just on this, right? So this chart that you can see on screen here is a GB chart. This effectively shows you the capture rates for solar in GB. The thing that I would really draw your attention to is that although the sort of annual rate appears to be around about 100%, this is kind of a familiar story for solar in that solar is an extremely good technology. It is very technically able to be delivered and at low cost. The risk on the revenue side starts to come when you have these really large cannibalization risks coming through. And so we'll have a look at Iberia in a second, but just having a look at some of those particular days in GB, you're seeing days come through, and these are by and large high volume solar days, where that capture rate for solar is getting down to a zero or a negative number. Now, that is really calling out one thing, which is that the capture rate for some solar assets is not linear. So it's not like you add 5% more solar capacity and your revenues for solar drop by 5%. When you get to certain points in power markets where you're effectively turning off gas units, you can move that quite quickly. So you can have a non-linear outcome from a linear growth of solar. And that is something which people who are very sort of long in the solar space need to be quite aware of. It won't necessarily hit sort of domestic in the same way, but it will hit some of these large sort of solar owners. There are ways that you can mitigate that in terms of contracting, but ultimately, like the cannibalization effects will be felt somewhere. And so this is a really critical trend as we start to move grids much more into sort of solar dominated to become solar dominated markets.
Great. Thanks, Ed. Yeah. And I think we don't really need to look very far to kind of see a lot of those dynamics in action either. So, looking kind of moving away from GB and looking at Iberia instead, we can see here Spanish solar capacity has increased from around 5 gigawatts in 2018 up to today 35 gigawatts. So, kind of a steady high deployment of solar over time. And we can see, these capture rates for solar started out at 100% and have dropped steadily since then. And, more recently, slightly more precipitously downwards. And we can see, again, a similar story, individual months, even in Spain. So most recently in May, where the capture rate for solar was just 10%. So solar really not earning much revenue across the entire month of May, which in Spain is a particularly acute problem where most of that solar capacity is installed on a merchant basis as well. So kind of very bad news for owners of those solar portfolios, just not capturing any revenue really there across the entire month.
Mm.
And we see this, kind of maybe not such a dramatic drop in the capture rate in GB, but we think that capture rates will decline for solar in GB as well. So looking here at some of the forecast results from our forecast, if we layer off a few of these things, we think that generally the average wholesale price is going to decrease over time. So that's just a result of that increased renewable penetration, solar during the middle of the day, wind overnight, pushing down prices at those times, decreasing the average price. But that kind of downwards trajectory is more significant and steeper for solar, just because solar is competing with other solar during sunshine hours, and those prices decrease more quickly, which means that the capture rate, effectively the difference between those two things, decreases to around 80% in the next 10 years. So a similar dynamic here where kind of solar portfolios are losing value over time. So, the question is what to do about this? Well, we think enter BES here, really. So we think that BES can be a good strategic hedge for this kind of cannibalization risk. So we're increasingly seeing those owners, as Ed said, those owners of big solar portfolios kind of coming to grips with this cannibalization risk and looking at BES as a kind of complement to their existing portfolios and a way to kind of mitigate some of that risk. And how that works, if we look specifically here in the GB market, we can take just solar revenues here and we can see that the average revenues for solar are very much dictated by the average daily price. So as the daily price increases, solar revenues increase, relatively straightforward. And when average prices are low, solar's not earning any money. When we look instead at battery revenues, we see a different picture and, nowhere near the same amount of correlation, really. And there are several cases in this data we've plotted here where the average daily price is zero. So solar wouldn't be earning any revenues, whilst BES still has relatively healthy revenues here. And that can, look like trading between a negative price and a positive price, where there's still a good spread in prices, but the average price across that day kind of averages out to £0. So yeah, kind of BES earning revenues where solar can't, and kind of complementing that overall revenue makeup of a portfolio as a kind of strong driving factor.
There's also from the Modo team in Australia, there's also a really interesting example of this where you had average daily prices that were negative in South Australia, and yet the battery fleet was able to make money working between two negative prices, which is kind of the ultimate example of how these two aren't sort of strictly correlated.
Yeah, no, exactly. It kind of seems counterintuitive at first, but I think that could be the way that, the direction of travel in a lot of these markets as well. And to look specifically at some of the kind of trading opportunities that this solar penetration and solar cannibalization provides for BES and how that kind of, can offset some of this risk, we thought it would be useful to look at the German market, where, obviously we saw in that kind of first few slides, a lot of renewables penetration there, a lot of negative prices. As a quick recap for some of our viewers who might be more familiar with the GB market, for example, this is a typical revenue stack for a German battery. We have some ancillary services, so FCR, frequency response service, and then AFRR, energy and capacity, which kind of like reserve and the balancing mechanism in GB. But then a big chunk of the revenue stack currently coming from merchant trading, both on the day ahead side and the intraday side as well. And we can see that the value in those merchant markets across day ahead and intraday kind of peaks in the summer months. So as you have a load of that solar generation online pushing down prices in the middle of the day, that boosts spreads from the day ahead spread, right? So you kind of increase your day ahead spread. But on top of that, in the German market in particular, there's much more of an incentive there for traders to balance their own portfolios. So kind of no paid balancing mechanism like there is in GB. There's a lot more liquidity and depth to the intraday market with tighter price signals there. Whenever you have those periods in the summer of high solar generation, it not only kind of pushes up that day ahead spread, but it adds a load of volatility as traders look to quickly balance their portfolio and kind of address the forecast error that solar introduces. That pushes up spreads there and creates this kind of very significant intraday revenue opportunity across the summer months. And we see that revenue opportunity then spreads through the revenue stack in Germany as well. So if we look here at FCR prices instead, we can see that battery traders are pricing in the opportunity cost of not trading in the intraday markets into their FCR bids. So FCR prices also peak in the summer months as traders are kind of off elsewhere, trading those kind of big spreads in the intraday market, and that pushes up prices in FCR and kind of boosts revenues across the board. So batteries here effectively doing very well out of kind of excess solar generation on the system. And the revenue case for Germany, and kind of one of the reasons we and I think the whole market are so kind of excited about the market, is that these spreads keep getting better over time. So the kind of case for flexibility continues to grow. We're plotting here the TBs in the market, so top bottom spreads, where a TB2, for example, is the difference in the average price of the lowest two price hours and the highest two price hours in a day. And we can see that from 2020 through to 2025, those spreads across durations have been increasing and trading much higher than they are here in the GB market. As a kind of, rough equivalence here, if you imagine trading the TB2 at 1.5 cycles per day, then the current value of that spread is around 112k euros per megawatt per year. So on a fundamentals basis alone, a very healthy revenue for a battery, even if you were to just take that day ahead value. And kind of leading nicely into an update that we've done to the Modo terminal recently, we've introduced these top-bottom spreads across markets. So here in Europe, kind of operating across a load of those markets that we saw in that first slide. You can now view, kind of the TB spread itself across different time ranges and a lot of summary statistics around distributions and probabilities associated with those TBs to allow you to quickly compare the kind of fundamental value available across different European markets from trading these spreads as well. So that's a recent update to the terminals that you should see, kind of having been rolled out for day ahead spreads and intraday spreads coming on there soon as well. And with that, I will pass through to Ed to talk about space.
Yeah, thanks, Joe. So yeah, as we said, time and space. Now we're moving into space. I think the time element in terms of the cannibalization is probably much more well understood, right? So cannibalization of renewable generation and the kind of the crashing of prices for negative prices and peak pricing in terms of scarcity, something that we all understand, and that's been around in markets for a very long time. You go back 10 years before BESS was really material, you'd kind of have gas peakers that would run at those peak prices. And so it's kind of very well known and very well understood. I think the transmission element is perhaps a little bit different. So, and here I'm talking about the constraints. So we have for a long time designed a network to move energy or electricity from large thermal generators to demand centers. And now we're starting to keep some of those thermal units on, but also are starting to totally replace the generation stack at the same time. And what that is doing is it's kind of starting to ask different things of our transmission network, and it's creating certain problems in the transmission network. So I'll describe kind of what the problem is a little bit, and then we're going to talk about where we think there might be potential value within this. So let's take a look at a few examples. So starting off with Germany, this is a view of congestion in the German grid in Q1 of 2024. And the coloring represents a percentage of time where those lines are congested. And so the kind of classic case here is wind in the north struggling to make its way down to demand that's kind of in the sort of middle and west. A few noticeable points around interconnection to Poland that are seeing some constraints come in, and we'll kind of talk a little bit more about interconnection in a second. But that is kind of a classic case of existing transmission network being overlaid with new renewables, then transmission network is struggling to keep pace with the growth that we are seeing in renewables because some renewable assets can take less time to be deployed. Batteries are a classic case of that, but solar would be another. Where you could see those assets being deployed with 18, 24, 36 months, whereas transmission lines can take 7 to 10 years to get constructed. And so it's very, very difficult for transmission lines to keep up with how fast the overall generation mix is changing. Let's take a look at another, because it's not all about north-south grids. The Iberian system is slightly more radial, perhaps. And here we've got sort of two examples. So we haven't got all renewables on this chart, but this has the wind asset. So wind is generally located in the north and in the sort of middle and east sections. And what you can see is that those assets are being turned down. And then you've got the gas assets, which are being turned up. Now, as many of you will know, the gas assets are often based on the coast because they need essentially cool water to run their cooling systems most effectively. And so that's why they're all based around the coast. And this is just to call it, again, this same dynamic happening. So you've got a legacy grid with reasonably limited constraints going to a renewable system, and then you're starting to see constraints emerging on that particular part or across the network. Let's take a look at one more chart here. So the other thing that I think is really interesting about this is that when we used to do these grids, we used to be very sort of concerned around scarcity pricing, and everything would be designed around how do we meet the sort of peak demand. So that's very much the left-hand side of this. So you'd be thinking around, okay, how do we sort of turn into import mode and bring in as much energy as possible and not export. And that is very much one of the problems that we used to have. We now have another problem on the grid, which is a negative price problem. And you can see here that this, by the way, what you're looking at here in red is exports, and in purple is the imports. And this is for interconnection in Germany. I should have said that at the start. But effectively, on the left-hand side with the scarcity, you can see, okay, a lot of interconnection is actually importing when there are scarce pricing events, so desperate for energy. Interesting to see some exports still running on those days as well, which maybe says that interconnectors don't always do what you'd like them to do. And then on the right hand side, you've got the negative pricing. So this is the opposite, where you've got too much generation and you're looking to move that generation to somewhere else. Again, more often than not, interconnection is exporting, but in some cases you're continuing to import even though you've got negative price periods, and so that's adding on this kind of additional complexity of space of how do you manage these grids when the types of problems that are being presented are really changing. So let's take a look at this final chart then for this section, which is starting to say a few things. And this is a little bit of a busy chart, so I'll explain a bit what's going on. So let's start with the x-axis. On the left-hand side of the x-axis, you have got the German system importing is on the left-hand side, and on the right-hand side, you have got the system is exporting. If you then take a look at the right-hand y-axis, that is the day-ahead price in euros per megawatt hour. And that effectively goes from top left to bottom right. And what that is saying is that when the price is really high, you are often importing, which is what you'd expect. And when that price is really low, you are often exporting, which is, again, is what you would expect. The thing that's then interesting on that chart is that when you then choose to overlay the renewable curtailment onto it, that doesn't actually match. So really what that is starting to talk about is that you are starting to get this sort of messy middle, I think I would describe it as, where you have a situation on the grid where you have reasonably good renewable generation, but you are not able to get all of that to be exported. And that is starting to call out that actually you are starting to see congestion in your system that's preventing you from doing the thing that you want to do. So either importing or exporting to help balance your system. So that giant sort of mound of red dots right in the middle, that is calling out that there are problems on the network where you are struggling to balance. And so really the thing that's interesting for me about this is that there is a balance between, yes, we can build more interconnection and that will help us in some circumstances, but that won't help us all of the time. And in those sort of messy middle periods, the one thing that's going to be really hard is if we have a lot of renewable generators that are being curtailed, depending on the market you're in, that can be extremely costly for the consumer. And if we allow kind of large costs to build through curtailment, then that can be a reasonably large problem for consumers, because then you lose momentum behind going through the transition, and that is sort of a classic problem in policy around net zero transitions.
Yeah. And I think the kind of way that I have thought about this previously is this kind of messy middle, as you describe, kind of represents trapped pockets of renewable oversupply, really, and highlights the need for that distributed flexibility from, things like battery energy storage, which can kind of mop up these local pockets of oversupply in particular areas where there's, say, a lot of wind or a lot of solar on the grid as well.
Maybe kind of one final thing to add to this. This is where regulation and policy really matters. So if you are curtailed, but then you're fully reimbursed, and that happens in GB, it also happens in Germany, then in those systems is less of a worry for the renewable generator, but it is a broader worry because those costs start to mount, and ultimately when consumers start to see costs coming through in their bill for sort of rebalancing or balancing costs, they don't really understand it. And with fair reason, it's kind of really hard to understand why you're paying for something that's not actually generating. if you're, say, in Spain, you don't that same dynamic doesn't come through. And so the eagle-eyed of you will have noticed from many slides ago that Spain had, although it had some frequency of negative priced hours, they were actually very low. That's because a lot of renewable generators in Spain do sort of self-curtail, and that's also because they aren't compensated in these periods of redispatch. There is nuance in that in terms of when that redispatch happens, and going into a little bit of the detail here, but the policy choices really do matter here in terms of the market that you're thinking about this in. Joe, I'm going to pass over to you for the latest from Modo.
Great. Yeah. So a few updates from our side until we get into the new age of certainty, which I think we're wrapping up with. But yeah, again, for the eagle-eyed or not so eagle-eyed amongst you, we are now running research in Germany and Iberia, as you've just seen in all of the preceding slides. So we have a whole load of new analysts starting here in our London office covering European markets and putting out articles every week across Germany, Iberia, and then soon moving into France and Italy as well. And we will have forecasts going live for Germany and Iberia before the end of this year. So our data science team working very hard across our kind of European fundamentals model at the moment, and looking to push out a version of our forecast there to better quantify that future revenue opportunity in those markets, as well as the kind of functionality on the TD side to quantify some of that current value as well. Just to flag that is now all available on the terminal, as well as solar forecasting in GB. So as you're used to with kind of standalone BES or co-located BES forecasting on the terminal, we now have the ability to do full self-service solar runs. So be that standalone solar, co-located solar and BES. Kind of can get very site-specific revenue curves from the terminal, right from kind of setting your grid connection location specifications through to the kind of BES side. And then on the solar side, we can either run a generation profile ourselves if we get all of those kind of good solar stats on tilt and azimuth location, or you can upload your own PVSys file there as well to get a site-specific revenue curve into the future for solar and start to kind of grapple with some of that cannibalization, see how that impacts things like CFD payments as well. So putting strike prices in there and seeing what that overall revenue stack looks like into the future, all possible through that. And then final plug from our side, I think if you are enjoying this live stream, then you'll be pleased to know that we have another one coming up next Tuesday, this time covering the state of energy storage in ERCOT with our colleagues Brant and Peter. They'll be running through what that market looks like currently. And I think similar to here in Europe, expanding across markets, also the case in the US as well, expanding across those ISOs, RTOs. This webinar, I think this live stream focused on ERCOT, but kind of, pushing out across those markets on the research side as well. So just to flag that that's all happening behind the scenes as well. And then I'll pass over to Ed for a new age of certainty.
A new age of certainty. Okay, we had a bit of fun with this title, maybe, in that, yes, we have certainty, but perhaps there are still gremlins in the system. And let's run through these and make sure we have time for the Q&A at the end, because lots of questions are coming in. So want to make sure we've kind of got through those. We've updated our CapEx projections for battery storage. This is mostly an update around the cost of longer duration battery assets, and so we are essentially seeing a lower cost for adding in more duration. That will be added to our forecast methodology, so anyone who wants to check it out can go there. So growing certainty around the cost of battery assets, and with that sort of growing certainty, we are now starting to see a little bit more of sort of longer duration assets coming into the picture. And so here we go up to something like 40 gigs of battery build out by 2050, which again is something we're getting more confidence in, particularly as we start to get sort of closer to the cost of some of those longer duration systems, and we're starting to get more certainty around the outcome of things like connections reform. This is obviously for GB, and for connections reform in GB. The intention was to get something like 22 to 27 gigawatts of battery capacity through. It looks like we're going to get a much bigger number. I know that Regen have been tracking people who've got planning consent coming through, and that number looks like it's probably going to be around the 45 gig to 50 gig mark. So something in the 40 to 50 gigawatt type range is theoretically possible. This obviously isn't just running off planning. This is running off a techno-economic model, and so yeah, we think we're going to get to around that 40 gig range. This does have some certainty in it. I think there's also there are still some, as I said, gremlins in the system. We have things like LDES, and the question on LDES is, well, how do we actually bring forward those LDES projects? How are Ofgem going to consider them? Is Ofgem going to sort of bring in a large amount of subsidy into the space, what I think would be overreach from a subsidy perspective, and what would fundamentally disrupt like market economics and ultimately bring higher costs to consumer? Maybe Ofgem will do that. Maybe it won't. We shall see. We'll know more in Q3 and Q4 of this year, and then there's expected to be another round of LDES from next year. I think that's supposed to be launched. So on one hand, certainty; on the other hand, uncertainty. Maybe go to the next slide. We also had our this is our future energy scenarios from the National Energy System Operator, which is called FES. This is our last one for 3 years, so it's starting to move to a 3-year cycle. I think the big thing here, of the 4 scenarios that have been looked at, the big thing is that the battery number has gone up. The reason why this matters is because things like connections reform and the Strategic Spatial Energy Plan, which is essentially central planning for the future of the electricity system, run off an element of the FES. And so these numbers going higher will encourage those processes to free up more capacity for batteries. And so I don't think the hydrogen evolution one is necessarily being taken that seriously. It has a lot of residential hydrogen in there, for example. But the electrical engagement, the holistic transition are probably 2 that you might want to look at. So that is more certainty, which is nice. I think then this is the last slide, and perhaps to kind of add a curveball into all of this, I think that we kind of referenced it earlier, but there is this with a national pricing system, which is something we now have certainty on. We still have some of these fundamental things happening within our network. So here we have a view of a particular boundary in GB. This is the B4 boundary. It's in Scotland, and this is essentially showing you constrained volume above the line. So times when you cannot flow more energy through that boundary, and then times where below that line you can essentially flow more energy through that boundary. And really, the reason why I put this in is because although we're getting sort of more certainty on fares, more certainty on connections reform, more certainty around REMA, I don't necessarily think we have fixed all of the problems in the system. And so whilst we still have very large constraints coming through, and this is a GB problem, it's a German problem, it's an Iberian problem, whilst we still have those constraints coming through and potentially raising some very large costs for the system, I don't think anything is really set in stone until we have some good fundamentals in place about how we're actually going to tackle some of these constraint costs. And maybe that's the point that I'll leave it at. And if you want to ask more questions about any of the slides you've seen, do get in touch with the Modo team. And with no further ado, we're going to go across to the Q&As. So I will get us started. We have the first question says, the negative prices tend to last for several hours, greater than 5 hours. In such a scenario, does adding BESS really make an impact unless we have 8-hour storage options? So yes is the simple answer. So first and foremost, your, say, 2-hour battery could work for the first 2 hours, but also your battery fleet doesn't actually have to behave like its nameplate duration. So we see this actually happening quite a lot in 2030s and 2040s, where although we have a battery fleet that is, say, 3 hours in duration, it actually makes sense for it to operate like a 3, 5, or 7-hour system. And so it sort of spreads its charge and discharge over what is economically the most rational thing to do. So yeah, does BESS help in a sort of 5-hour negative price situation? Yes, the answer. Okay, then a second one, I'll perhaps take this one, which is, could you give an example of best earning whilst in negative priced hours? I think I raised this about South Australia. So just imagine a world where the charging price is minus 100 Aussie dollars and the discharging price is minus 30 Aussie dollars. You have a positive 70 Aussie dollar spread. And so that is how batteries make money. Joe, maybe so next question is, what are the main structures for BESS, both standalone and co-located with PV, in order to be bankable in Germany and Spain?
Great question. So I think, yeah, maybe tackling the standalone side and kind of bringing in some of what we see in other markets as well. I think generally in terms of offtake structures, we're seeing the space evolve quite quickly on the offtake structure side. So moving beyond your kind of classic floor or physical toll into, I guess, to bring in another Australian example, into things like revenue swaps, virtual tolls, day ahead swaps. And these are really kind of instruments that let BES owners kind of contract out relative portions of their revenues. So a day ahead swap, for example, kind of lets you extract contracted revenue from the day ahead wholesale portion of your revenue stack effectively. The banks like them, and you can kind of play around with the structure in there to get as kind of much or as little debt or leverage as you need against a project to get that built. I think it's obviously in Iberia, it's a nascent market, only 18 megawatts, I think, of storage build out so far. So kind of, yeah, remains to be seen what a truly bankable structure looks like there. But in the German market, we're definitely seeing all of those things in play at the moment as well. So definitely around things like virtual tolls, day ahead swaps, and kind of layering those contracted revenues on top of each other, depending on the amount of leverage that projects need to get on board generally.
I think we have a transmission episode coming out either this week or potentially next week on that as well. So keep a lookout for that. What does trading TB at 1.5 cycles mean? Shouldn't it be only one cycle? Do you want to have a go at that, Joe?
Great question. I think so. Trading the TB at 1.5 cycles, I guess, yeah, just to kind of proxy generally for that fundamental value, I would say. So TBs generally kind of ignore that, whether a spread is physically possible to trade. So like you say, it might be kind of physically impossible to trade that TB at 1.5 cycles, but just a kind of general assumption that I think is quite commonly made across the industry that if that were possible, that's what the kind of proxy value in kind of, yeah, euros per megawatt might look like.
I think to add something to that as well, in most sort of power shapes, you generally tend to see sort of very low pricing overnight, morning peak, low pricing middle of the day on solar, high evening peak pricing, and so it is very much possible to have one or one and a half goes at a sort of off peak spread, and so 1.5 cycles is pretty much in line with what we see some of the sort of best performing GB assets do in the market today. Okay, we've got another one. So how can best co-locate alongside a demand source, e.g. a data center, and earn revenue? Joe, if you want to take that one?
Yeah, I can have a go. Um, generally, yeah, we've kind of, I guess, seen less of that kind of co-location in the market. We've seen a pretty healthy market for supply side co-location. So co-locating with solar, we think makes a lot of sense, and with wind. On the demand side, it's really just about using the kind of trading around the demand profile of a data center, for example. So data center demand can be relatively predictable in terms of peak times, and then you're effectively constraining your battery to trade around the kind of peaks and troughs in demand from the data center on the grid, and can be a way, in a world like in GB, for example, where the kind of constraint on the network on the number of individual grid connections and whether you can get a grid connection. I think, yeah, it's kind of an increasing area of interest in terms of co-locating assets to, share grid connections and kind of extract as much value as possible from those grid connections.
I think one big part of this whole process on this co-location is that it depends what the actual site looks like. So if you've got something like a very large warehouse that doesn't have a huge amount of energy use, then it's quite possible to put a lot of solar on the roof, let's say, and then use the battery to capture any excess solar and shift that to times when there's not solar generating. And so you can essentially bring the asset as off grid as possible. And that process is very valuable. The question actually says, e.g., data centers. And so I think what I'd warn about data centers is that because they're so energy intensive, it can be really hard to get sort of excess solar. There is generally not enough roof space to actually do that. And so that makes it quite difficult to be able to sort of play that capturing the excess solar generation in a behind the meter case. Okay, we've then got a question on is this trend for Germany on interconnection versus renewable curtailment and day ahead price the same in GB? Yeah, good question. We absolutely do see constraints coming into the market all of the time. In fact, the last sort of 2 years have been extremely constrained in GB. On top of kind of the dispatch of interconnection within Germany, we then have a different way of operating interconnection between UK and Europe, which means that there's kind of another layer of complexity, which brings in another layer of sort of non-perfect dispatch of interconnection, which is again a problem. So yes, we definitely do see it, and yes, there is that same pocket for storage to essentially provide value. Next question, is there a place for longer duration storage in these markets? Are they viable without a capacity market, 8-hour redox flow, for example? I can take this one. Used to do some redox flow, so happy to sort of answer this. Is there a place for longer duration storage in these markets? Yes, of course, there's a place for longer duration storage. The commercials, however, have to add up to make that realistic. And that is often the thing that's quite difficult. And so the thing around long duration that makes it quite hard is that a lot of markets are based around human behavior. So in the morning peak, you might have 3 to 4 hour peak, where essentially people are using quite a lot of demand or creating quite a lot of demand. And then you have solar that kicks in that kind of brings down prices in the middle of the day. And then as solar kind of wanes off, you then have demand that say picks up for the end of the day. And there's a kind of natural cycle between those things that calls out for something like a 3, 4, 5 hour duration. And you can see that in those TB spreads. So the TB spreads, if you see where they started to flatten off, where they're flattening off, that's essentially saying that, yes, you could have something that's longer duration, but you're not going to get paid much more money for it. And so is there a huge amount of value in going much longer duration? It depends how much it costs you. If it's costing you a, say, fixed rate as per lithium systems, then we don't think people would naturally move to build 8 or 10 hour systems. If there is a direct subsidy in place that's asking you to build 8 or 10 hours for something like security of supply, then absolutely, then say 8 hour systems could come in. The area where things like redox flow are interesting, and you can kind of bucket all other storage techs into this, is where those techs have a very low cost of adding additional capacity. That's where there's potential for them to be able to do much longer duration. We shall see what comes through. We have the long duration energy storage subsidy running in GB, and we shall see what sort of wins through that process throughout the course of Q3 and Q4 of this year. The next one, a nice easy one. Will the slides be shared? Yes, we will definitely share the slides, and we'll share them in a way that allows you to also link through to some of the underlying articles as well. So Modo customers will be able to go to the specific articles. If you then get to the articles and you're seeing that you can't actually read them, please get in touch, and we'll make sure that we can set you up the team to have that conversation. Okay. We have got a minute left, and we have potentially another 15 questions. So we won't get through all of these, but maybe we'll just take perhaps a few more. So here we have one that says, could you explain in more detail the impacts of negative prices on the consumer in different countries' regulatory framework, and could there be an EU-wide intervention? That is going to take longer than
not a minute left question.
Yeah, that's not a minute left question, is it? I already picked the wrong one there. But the impact of negative pricing is actually a bit of a funny one. So some grids are actually quite happy to see negative pricing. They see it as a call for more flexibility, and I think I agree with that. There are other grids where they try and actively limit negative pricing. Spain and GB would be examples of those. And I think that's a mistake. I think that's essentially sort of diminishing the role of the market. in trying to balance your system. And I think ultimately it means that you end up paying sort of more subsidy to market participants. And I don't think that's in the interest of consumers. So um, do I think there'll be an EU-wide intervention? No, no, I don't. But thank you for the question. I'm sorry we can't spend more time on it. Maybe we'll just pick one more question, and I'll just pick one from Henry, who's put his name in, which is always nice. So well done for putting your name in, and we'll take your question as a result, which says, how do Modo see augmentation strategies across the UK? And what's its impact on revenue stacking and optimization strategies? Will it have an impact on certain markets saturating? So we definitely see augmentation happening. Gresham's a classic example of that. They've been working really hard to bring a lot of their sort of early sort of 2017, 18, 19 assets up to be 2 and 3 hours in duration. And what's really interesting about some of those sites is that the sites, they haven't necessarily had to go and procure more land. They've been able to use the existing land and the existing setup of those sites. But because batteries have become significantly more energy dense, you have been able to put on a 2 hour site on what was a half-hour system from, say, 6 or 7 years ago. And that can be a really lucrative thing. So we've seen, as I said, Gresham is kind of the classic case of it, but this is something that we absolutely expect to see across the UK. How does it impact revenues? So yes, we definitely see 2 and 3 hour systems running different revenue optimizations compared to half-hour and 1 hour systems. So that is also happening. And will it have an impact on certain market saturating? To some degree. I don't think it is at the scale that we're currently at, which is sort of 5.5 gigawatts of batteries, 1.5 hours in terms of duration. No, it's not kind of moving the needle on saturation. But really interesting question, and thank you for asking them. My apologies for everyone who asked a question and then we didn't answer them. Please feel free to send them in to me. I'm ed@modoenergy.com and joe@modoenergy.com as well. We'd love to get your questions and very happy to help answer them. All that remains is for me to say thank you very much for tuning in. Hope to see you next quarter, and have a great week.